When it comes to your retirement planning, the single most important variable that will directly affect your retirement income are taxes. Taxes are going to impact your retirement income more than anything else you could possibly do. And we as Americans have been told since the 1980s, shove money into 401ks, shove money into IRAs. You're going to be in a lower tax bracket when you retire. Defer, defer, defer. What we essentially were doing is pressing pause on paying taxes until later in life. So that begs the question, where are tax rates going in the future? If you don't think taxes are going to be higher, then sit tight and I'll explain exactly why they will. But first, let me introduce myself. I'm Marcus Warren, financial planner, tax enrolled agent, and my firm is called Warren Wealth Management and Tax Planning. We're a fiduciary registered investment advisory firm located in Louisville, Kentucky. We're also a Dave Ramsey endorsed local provider and also part of his SmartVestor program. Oh, I've also written a couple of books. One is called The Retirement Playbook, and the other, recently released book, is called The Tax Playbook. I also host a radio show and podcast called The Race to Retire Show. Yes, I have another podcast that's called The Tax Playbook. So, before we really get into the meat of today's presentation, I want to let you know that by attending this webinar, you have the opportunity for a 45-minute strategy session designed to answer your specific question. So, during this presentation, I will be talking in general terms, and the concepts I discuss may or may not be applicable to you, or you're just not sure how to get started. The strategy session gives us an opportunity to sit down and see if we can incorporate these concepts into your financial plan. That is, if you even have a financial plan. But even if you don't, we can help with that too. So, whether you're concerned about recent market losses or protecting your IRA and 401k from high taxes, we can help you address those concerns. And we also have an incentive. So for those of you who schedule and attend your strategy session, you'll get a free report showing the 6 big tax mistakes that you can't afford to make. And you'll also get a copy of one of my books. Now, because we're offering this free of charge, the offer is only good for 30 days. So again, we'll put this icon back up again throughout the presentation. And if you'd like to set up a time to meet with us, feel free to click on the icon before the end of our webinar today. And if you have any specific questions you want to ask me, you can submit them in the chat box on your screen. Now, those will come directly to me and I'll respond to them. So let's jump right in. Now, before we can talk about taxes, there are a few things we need to understand. So the first thing you should know is that there are 2 types of taxes. The first type of tax is the one that you don't necessarily have to pay. And I think that we can all agree, if there is a tax that we don't have to pay, let's not pay it, right? Now the second type of tax is the one that no matter what, come hell or high water, you're gonna have to pay. And if that type of tax exists, can we all agree that we want to pay that tax as cheap as humanly possible? So if most of us can agree that tax rates aren't going any lower, they're probably going to go higher, is now maybe a good time to actually pay some of that tax? It might be. It just might be. But in order to answer that question, you need to know more about your tax situation as retirees. Now, there are many different individuals or couples watching this presentation right now, and each of you have done different things in your life when it comes to your finances. You might have money all over the place, but regardless of where you have money saved, I can break it down to you into one of 3 different tax situations, or tax buckets as we call them. So the first tax bucket we're going to talk about, we'll call the taxable bucket. Now, things in this bucket are taxed as they grow. Things in this bucket produce interest, dividends, capital gains. So what are some examples of things that might be in the tax bucket? You have CDs, stocks, bonds, mutual funds, you name it. Those are taxable assets. So how do you know what you have is a taxable asset? Well, there's a love letter that you get every year, late January, early February, and that love letter has a 1099 in the corner. Now that 1099 is telling you and Uncle Sam, hey, you've earned this much interest, dividends, and capital gains. Please include this on your tax return. So if everything in this bucket, the taxable bucket, is taxed as it grows, why do we as Americans even put money in this bucket, besides not knowing what else to do with it? Well, we put money in this bucket generally because it's extremely liquid. So what does that mean? Liquid means you can easily get to it quickly. And if it's extremely liquid, it makes for a great emergency fund. So how much money should we have in an emergency fund? Now, those talking heads on TV who disagree about everything and just yell at each other over and over and over again, this one question they usually agree on. You want around 6 months worth of living expenses in your emergency fund. Now, there can be many reasons to have more. You might even have less, but 6 months is just the general good rule of thumb. Now, can you have too little in your emergency fund? Yeah, you can. It's when credit card debt sneaks up on you and bites you right in the butt. Can you have too much? Well, you never can have too much money, but from a tax efficiency standpoint, you can have too much money in this bucket. I want to give you an example. So there was a couple that walked into my office about 2.5 years ago, and they showed me the last 2 years of their tax returns. And as I'm looking at those returns, the taxes they paid on that money in this bucket, now not the money they earned in gains, but the taxes they paid averaged $40,000 a year for those 2 years. They had way too much money in this bucket. Now, the problem of paying a tax on money in this bucket, now this is one of those taxes that I told you at the beginning that you don't necessarily have to pay. And if you pay a tax that you don't have to pay, you lose not only that tax, but you also lose whatever it could have earned for you over your lifetime. And so the couple that I told you about, they were 55 years old. They had no children, and all they cared about was leaving as much money as possible to their church. Let's say they lived to 90 years old. How much would that $80,000 have grown to over the 30 or some odd years that they had? It's a giant amount. It's huge. And that's the amount that the church lost out on because they had too much money in their taxable bucket. Now, this is something that I see frequently with the people that I meet with. Now, if you want to know whether you can better leverage the money in your taxable bucket, then please schedule your 45-minute strategy session with me just to get started. All you have to do is click on the icon that pops up, select a time to meet, and we can discuss whether it makes sense for you to reposition some of your savings and investments. Okay, so let's talk about the next bucket. This is the bucket that every other advisor focuses on. This is where I'm going to guess for the last 35 years, you lived your financial life. We call this the tax-deferred bucket. So with the tax-deferred bucket, you're not paying taxes on the growth. You are paying taxes when you take money out of this bucket. So what are some examples of these? 401ks, IRAs. If you work for a nonprofit, maybe a 403b. If you work for the government, maybe you have a 457. These are referred to as qualified plans. So what does a qualified plan mean? Well, a qualified plan means that the United States Congress has bestowed some special features upon those assets. What are some of those special features? First, when you put money into this bucket, you are usually, not always, but usually getting some sort of tax deduction. So what do I mean by a tax deduction? So let's say between you and your spouse, you earn $100,000 a year, and you take $10,000 and you put it into your 401ks. You're going to pay taxes on $90,000. That, my friend, is a tax deduction. But when you take money out of that bucket, the IRS has a very special name for this income. What do they call it? They call it ordinary. Ordinary income. And ordinary income means that whenever you take the money out of this bucket, it gets dumped on top of all the other income and is taxed at whatever the tax rates happen to be when you take that money out. Now, having money in this bucket is kind of like going into a business partnership with the IRS. Except in this business partnership, your partner every year is going to sit down and tell you how much profit you get to keep. You have no say in it whatsoever. The only control you have is when you get out of that partnership. That's it. Now, there's one important thing you need to know about money in this bucket. Once you put it in there, it is virtually impossible to get it out without it being taxed. If you take it out during your lifetime, it will be taxed at your tax rates, whatever they happen to be. If you give it to your kids or someone else, it will be taxed at their tax rates, whatever tax rates happen to be when they take it out. It is virtually impossible to get money out of the tax-deferred bucket without it being taxed. Now, when I tell people, maybe now is a good time to pay some of that tax, they'll usually look at me and say, oh, why? I don't want to pay tax now. So I want to tell you a little story. I want you to think back to Christmas morning 2017. You wake up Christmas morning, you stretch. You look outside, it's snowing, it's beautiful, it's a white Christmas. You do what you do every Christmas morning. You run over to your computer to log into your Fidelity account. And you look up and you are ecstatic because your Fidelity account says you've got $1 million in your 401k. This is fantastic. It's Christmas morning, you got $1 million in your 401k. What could be better? Well, what the Fidelity account doesn't tell you is that $1 million isn't all yours. If you're in the 25% tax bracket, what you're actually doing is you're holding on to $250,000 for old Uncle Sam. Only $750,000 is yours. And the problem is, Fidelity doesn't know how much or what tax bracket you are in. So they just show you the full $1 million. But trust me, they're holding on to some of it for old Uncle Sam. Now, I want you to fast forward 1 week, New Year's Day 2018. You're sleeping in a little bit. Maybe you had too much fun the night before. You wake up, you say Happy New Year, and you run to your computer and you log into your Fidelity account. And it says the same $1 million. But guess what? Overnight, you got a present of $30,000. What do I mean by that? Well, overnight, the new tax law came into effect. If you were in the 25% tax bracket, all of a sudden, you went to the 22% tax bracket. Uncle Sam only wants $220,000 now. You can keep the rest. So, could he change it again? Of course he could. In fact, the law says he is going to. It's coming back. He's going to take the rest of it real soon. Could it go higher? Of course it could. What if he wants 30, 40%? Then that becomes your loss. You see, people get very concerned about stock market loss. They sell out when it becomes volatile, they make emotional decisions, and they lose money. But guess what? History shows that when the stock market has gone down, it also recovered and eventually came back up. If Congress raises taxes, do you think they'll bring them back down? A tax increase has the same impact on your money as a market loss. So, how much money should you have in the tax-deferred bucket? Now, we have a term in our office and we call it RMD tax-free. So what the heck does that mean? Well, there's a special rule that you need to know about. Now, there are some people who might just think, I just won't ever take money out of this bucket. I'll just leave it in there and I won't pay taxes on it. And that's a great plan until you turn 72. Because once you turn 72, the government requires you to start taking money out of this bucket. They call it required minimum distributions, or RMDs. And if you don't take your RMD, or if you don't take enough of your RMD, they have another special rule. They're going to tax you as if you did take it out, and then they impose a 50% 50 penalty on top of all that. They are very serious about you taking your RMD. So how can it be RMD tax-free when I just went on a diatribe on how everything in your tax-deferred bucket is going to be taxed? Well, let's think about the Form 1040, the tax return. Every tax return has two parts. They have an income section and they have a deduction section. So what are the biggest deductions Americans have? Our house and our kids. But what happens as soon as we get to retirement? Most people try to pay off their house and everyone is trying to kick their kids out of the house. Your deductions start to go away in a time when you need them most, probably more than ever. But lucky for us, there is a minimum deduction the IRS grants to everyone. Now, for a married couple last year, they had to take their RMDs, which means they're over 72. That minimum deduction was about $27,000. If you're single, just divide that in half. So that meant that last year, if you can keep your RMD and all other income below $27,000, you can take it out virtually tax-free. Now, is that a good deal? It's a great deal. And is it easy to do? Well, it depends. Now, for some people, yes, it happens pretty fast. For some people, there's some work to do. For others, you probably have a lot of work to do. But is it worth it? Yes, it is. every single time. So how much is RMD tax-free? It depends. It depends on how much is in your taxable bucket. It depends on how big your Social Security check is. It depends on if you're married or not. It depends on if you have a pension. It depends on how charitable you are. All those variables go to determine how much your RMD tax-free amount is. But everyone has one. So a general rule of thumb is it's never less than zero, and I've only seen it above $600,000 once. So somewhere between $0 and $600,000. Now this is why I get paid the big bucks. I know that most people watching this webinar have their retirement savings in their tax-deferred buckets, in their IRAs, the 401ks, so forth and so on. And the million-dollar question is, how do I make my retirement money last without having to give 40 or 50% of it to Uncle Sam? So we run this analysis for our clients annually at our tax planning meetings, and we can help you too. All you have to do is schedule your 45-minute strategy session with me just to get started. Click the icon that pops up, select a time to meet, and we can discuss whether some of these tax saving strategies will work for you. Now, this last bucket is the one that everyone always wants to talk about. We call this our tax-free bucket. And there are a lot of assets that like to masquerade as tax-free, but I have two tests that an asset needs to pass before it is considered tax-free. So the first states that in order for something to be considered tax-free, there needs to be zero taxes at a federal level, zero taxes at the state level, and no capital gains tax. So let's talk about one of those assets. So when a client comes into my office, they'll show me their account statements, and I'll ask them, why are they holding these investments? If they're holding muni bonds, usually the answer is, I want the tax-free income. First off, I want you to get as much tax-free income as possible. But let's look at municipal bonds in this first test. So are muni bonds tax-free at the federal level? Yes. Are municipal bonds tax-free at the state level? Maybe. Now, in order to answer that question, you need to know more about what a municipal bond is. So, a municipal bond is loaning money to a municipality and then paying you interest in return. So, I live in the Commonwealth of Kentucky, as it's called. If I buy a municipal bond, I am essentially loaning money to the Commonwealth of Kentucky, and any interest that I earn on that is tax-free in Kentucky. But if I was going to loan money to any of the other 49 states, guess what? Kentucky will gladly take that tax payment. Now, let's say you want to diversify your municipal bond holdings, so you buy a muni bond mutual fund. Now, it's a legitimate way to do it. You hold on to it for 10 years or so, and you no longer need it, and you want to get rid of it. So you sell it. But in that time period, it's doubled in value. Are you going to pay capital gains tax on that? Yes, you will. So the second tax-free test is something that when I show it to people, they look at me like I'm crazy. A tax-free asset should not cause your Social Security to be taxable. All right, so let's take a step back for a second. Social Security and Medicare taxes are called FICA taxes. And those were withheld and paid from your paycheck all those years you worked. That wasn't like your 401k, which just deferred your contributions. You've already paid taxes on the money that gets put into the Social Security and Medicare fund. And when Roosevelt signed Social Security into law in 1935, he made a promise to us. His promise to us was that we would never pay taxes on our Social Security earnings. Guess what? Those laws have changed. Twice. Most recently by President Clinton in the mid-90s. Now, up to 85% of your Social Security might be taxable. But the word might is the key term here. Because if your Social Security is taxable, what does that mean? That means that you have to spend down more of your other assets just to live the same lifestyle. That means you are going to leave less money to the next generation, or your money is going to run out substantially sooner than what you want it to. So how do you determine if your Social Security is taxable? Well, the IRS, they use a calculation called the provisional income calculation, and here's how it works. First, they take about half of your Social Security payments for the year. So if you get $30,000 a year in Social Security payments, they're going to take $15,000 and they're going to put it into that equation. Then they'll take any taxable income you have. So any interest, dividends, capital gains. If you're still working, they're going to take your wages. They take tax-deferred income, so your IRA, 401k, or pension distributions. And finally, any tax-free interest, including municipal bonds, and they add it all up. And if that comes to more than $44,000 and you're married, congratulations, up to 85% of your Social Security is now taxable. The magic number is $34,000 if you're single. But if you're married, I'm going back here, and you keep that number below $32,000, none of your Social Security is taxable. Now, is that a big deal? Of course it is. It's huge. Is it easy to do? Well, to be honest, for about 20% of the population, it's actually impossible. You can't do it. But for the rest of you, it depends. It can be easy, or you might have to work for it. But is it worth it? Well, in order to answer that question, I want to give you an example. And this example comes from my all-time favorite client, my mom. So I've been helping my mother with her retirement planning for a little over 15 years now, and it's been a very important undertaking, and I feel honored that she has placed her trust in me. Business and family generally don't always mix well, but in this case, it's worked out. Well, she hasn't disowned me yet. Now, my mom has worked hard her whole life, first at a beef processing plant and later in retail at a grocery store. So when I said to her, let's talk about Social Security, she looked at me and she said, Marcus, don't worry about Social Security. I'm going to work until I'm 70 and I'll just turn it on then. And I was a little surprised since most people collect Social Security early. So I asked her, I said, well, how much is it going to be then? And she looked it up and she got her statement and she said it's just going to be a little bit under $36,000 a year. I said, okay, fantastic. I said, but how much are you going to have to pay in taxes on that? And so she looks at me and she says, I don't know, you do my taxes, you let me know how much I'm going to pay. And so at that time, she was in the 25% tax bracket. So I said, well, 85% of your total benefits times 25%. So it'd come to around $7,650. And she says to me, she says, if that's what I owe, then that's what I owe. And that's a common thing that I hear from people. So I said to her, I said, Mom, what if you didn't have to pay that tax? She thought about it, and she said, if I don't have to pay it, I can leave it to the grandkids then. I told her, yeah, that's entirely up to you. In fact, if she didn't have to pay that tax, she could leave it in her account and just let it grow. And let's say that instead of having to pay taxes each and every year, she was able to put that money in an account and it grew at 8% a year. You know, over 20 years, that account would be worth over $413,000. So at this point in time, my mother, she was ecstatic. She says, you mean I have a choice? I can pay the IRS $7,650 every year, or I can leave my grandkids an extra $413,000? I said, yeah, Mom. That's pretty much your choice. Lucky for me, she loves her grandkids more than she loves the IRS. And this, my friends, is the power of taxation on your Social Security. So this is a webinar, but I love giving this presentation in person because at this point in time, I get to see the look of shock on everyone's face. And if I could see you all through the screen, I'm sure it would look the same. Because most people don't truly understand the impact of Social Security taxation. And as a matter of fact, a lot of people I speak with didn't even know their Social Security benefits were taxed in the first place. Because you were already taxed on this money on the way in with each paycheck that you contributed to the Social Security fund. And now you receive the benefits, you will likely have to pay taxes again. So, what can you do? Well, there are steps you can take to ensure that your provisional income stays below those thresholds that the IRS throws out to tax your Social Security benefits. All you have to do is schedule your 45-minute strategy session with me to get started. Just click on the icon that pops up, select a time to meet, and we can begin to look at whether your benefits will be taxed and what you can do about it. And if you're already collecting Social Security benefits, it's not too late for you either. Click to schedule your 45-minute meeting with me. So, what is a true tax-free asset? Well, there are a few. So the first we use day in and day out, and we consider this to be the single greatest benefit granted to us by the Internal Revenue Code, and those are Roth IRAs and Roth 401ks. And it doesn't matter how old you are or how much you make, you can use Roth IRAs. Now, the second tax-free asset we use very rarely, but when we do, it has some really cool features, and that's specifically designed life insurance. Then there are also HSAs or health savings accounts that you can use for healthcare, or 529 plans that you can use for education. Now, how much did you have in that tax-free bucket? Well, we have an acronym in our office, and that's AMAP. As much as possible. This is what I refer to as tax utopia. Now, tax utopia is different for every single person. How you get to it is different for every single person, and what it means for you is different for every single person. But the value of tax utopia is multiplied when it's tied in with how you're looking at your asset allocation and your income. All right, so throughout this presentation, I told you about the opportunity to schedule that strategy session. It really can be considered a continuation of this discussion because that consultation, it serves as two purposes. First and foremost, the information we went through is extremely general, and you're very personal. All your retirement advice should be extremely personal and designed exactly for you. So that consultation is all about you. So in this last example, I talked about my mother, and my mother isn't important. Well, of course she's important to me, but not to you. Nobody else's tax utopia is important. Yours is important. And the second purpose of the consultation is for us to get to know you and for you to get to know us a little better. We are a full-service investment advisory firm, and we combine investment management and tax planning because they go hand in hand. And at the end of that strategy session, we'll be able to tell you whether we can help you or not. Now, around 90% of people that we talk to, we can help in some way, shape, or form. Now, the reason people come in to see us, first and foremost, is about investments and taxes. Those are the two biggest reasons. Social Security and pensions, those are other hot topics. The stock market's a hot topic, especially right now. We're hearing a lot about Medicare and long-term care. Those are all great reasons. Whatever your reason is, the consultation is worth it. So, after that 45-minute strategy session, you may want us to take a more in-depth look at your retirement planning. And we call this our tax and retirement audit. And that takes anywhere between 60 and 90 minutes, depending on how complex your situation is. And in that tax and retirement audit, we're looking at several things. First, we're trying to get to know you in order to help determine your financial goals. Then we're looking at your income. We're looking at where your money is coming from, how your Social Security is set up. Will you receive a pension? Do you have other sources of guaranteed income? We're going to look at asset allocation. And then finally, we're going to look at your tax utopia to see where you are now and if we can achieve that. If you'd like to take advantage of that, the best place to start is by scheduling that 45-minute meeting. And don't forget, for those who schedule and attend your strategy session, you'll get a free report showing the 6 big tax mistakes you can't afford to make and a copy of one of my books. You know, I think in all of our lives, there are things that we put off thinking that we can always do them later. That's not always true, especially when it comes to tax planning. We have a limited time to take action because taxes are going up. In fact, we know that the current tax cuts, they're going to expire, and we know exactly when they'll expire. And that, my friends, is December 31st, 2025. There's only 5 or so years left. The clock is ticking. That's why it's important to take action now. Schedule your 45-minute strategy session. Until next time.